3, 2, 1, blast off! It's no secret that mortgage rates have doubled since last year. They have risen from about 3% earlier this year to about 7% now. So if you take a $300,000 mortgage, for instance, that'll add about $700 to a possible buyer's monthly payment. That's a significant amount for most families. So instead of delaying the purchase of their new home until rates come back down, we're looking at different options to ease their monthly payment. That's why everyone's talking about interest rate buydowns. If you're on social media at all, you've seen and heard a bunch of talk about 2-1 and 3-2-1 buydowns. These types of buydowns have been around for a really long time, but it's been about 30 years now since anybody's really been using them, and they're coming back in style now. These are best thought of as temporary rate buydowns, whereas buying traditional points are more permanent buydowns. So how do they work? In a 2-1 buydown mortgage, the interest rate in the first year is 2 percentage points lower than the fixed base price. So if we go back to the 7% marked fixed rate and then you do a 2-1 buydown, the interest rate for your first 12 payments would be at a 5%. In the second year, the interest rate is 1% lower than the base fixed price, so you'd be paying 6%. In the third year and for the remainder of the loan, interest rates would be at the base rate of 7% and stay there for the remainder of the loan. The 3-2-1 buydown mortgage is very similar to the 2-1 buydown, but the savings lasts longer. The interest rate in the first year is 3 percentage points lower than the base rate. So year one in our example of the base rate of 7% would be at 4%. In the second year, the interest rate is 2% lower than the base rate, so at 5%. In the third year, the interest rate is 1% lower than the base rate of 7%, so it would be at 6%. In the fourth year, the interest rate moves to the base rate and stays there. The benefits of these loans are fairly obvious. A lower interest rate in the first few years, but without the higher cost of buying down points permanently. And unlike an ARM, the buyer knows the future interest rates they will pay with certainty if they don't refinance first. What's important to know is sellers, including new home builders, can pay for these temporary buydowns. The seller pays the amount up front, and those funds actually go into separate account. So when the buyer makes their monthly payment every month, they make the reduced payment amount, and then the lender takes money out of the seller's account to make the payment whole, and that combined amount is which then sent to the actual investor, whether it be Fannie Mae or one of the other big entities that purchase mortgage loans. The temporary buydown is a great fit for someone that thinks they're going to be refinancing their mortgage in the next couple of years. A lot of loan officers are having discussions and believe that rates are going to come down in the next 8, 12, or 24 months. So most of those 7% loans that are going to end up refinancing anyway. This type of buydown works for people who are like, I'll buy the house at the 7% base rate, wait for the interest rate to drop naturally to around 5% in a few years, and then refinance without ever having to pay the 7% rate. If you're a little more conservative and you don't want to take any interest rate risk, another option is to do a permanent buydown. It has lesser payment impact, but it's for the life of the loan. So you could pay 1% of the loan amount, and that would drop the rate maybe a quarter point, maybe a little bit more, and then it stays there for the life of the loan. Or you could pay 2%, which is 2% of the loan amount, and drop it maybe a half a point, so that way your monthly payment would drop about, probably about $100 on a $300,000 loan. This is a good option for those who want to know what their payment's going to be forever. So now you know all about buydowns and how they work. They really are a great option if you're thinking about purchasing a home while the interest rates are high. It's a great opportunity to purchase before the buyer frenzy begins again once the interest rates drop organically in the next year or two. Thanks so much for watching, and if you enjoyed this video, let me know by giving it a thumbs up. If you have any questions, drop them down below in the comments. And lastly, if you'd like to see more videos like this, then be sure to hit the subscribe button for more Columbia real estate advice, news, and homes. See you next week.